Home builders just caused the housing market to crash even worse than it did back in 2008, with the median sale price of a newly built home collapsing by 18% over the last year, the biggest decline on record, and a signal that this housing downturn is going to get even worse heading into 2024, because these builders are leading the rest of the market, everyone. They've been very aggressive in cutting the price and also very aggressive in giving extremely low mortgage rates, with some builders now offering sub 3% mortgage rates, something that is now causing devastation in a housing market like Austin, Texas, where we can see listings like this on Zillow. It's a 4-bed, 2-bath house that they bought from the builder back in 2019. Well, now this owner wants to sell, and they've had to cut the price by 23%, by almost $100,000. And even after that price cut, the house is just still sitting on the market for 136 days. Why? Because if we look at all the other listings around here, we can see it's new homes, builder homes. So if you buy a house from a builder, you might like the deal up front, but then later on, if you have to sell the home, you're going to realize you don't like owning in a home building community, because you're going to have to compete against the builder who's offering a 2.99% mortgage rate up front to a new buyer. How are you going to compete against that if you're an existing seller? You can't. And folks, we're actually starting to enter a crazy situation right now as the calendar turns into 2024. And that's that since the builders have cut the price so much on the homes that they're selling, we're now in a situation where it's almost cheaper now to buy a new house compared to an existing house that someone has already lived in. Check this out, everyone. The yellow line tracks the price of new homes over the last 25 years, which is data from the US Census Bureau, while the blue line tracks the price of existing homes, which is data from the National Association of Realtors. And what do you see, everyone? The median sale price of a new home costs $409,000, while an existing home costs $392,000. So the new home is only 4% more expensive than the existing home in nominal terms. Folks, you can see that this is a actually historically low premium that new homes are getting compared to existing homes. Typically this premium is around 20% over the last 25 years. Now it's only 4%, an indication that the price of existing homes is going to have to go down and follow suit as well, everyone. That's the thing that you got to understand about these builders with what they're doing. They are showing you what has to happen in the housing market more broadly for home buyers to start to return to the market. We need to see a 15 to 20% decline in prices, plus we need to see mortgage rates go down to 5 to 6%. If that happens, then buyers will return to the market. If that doesn't happen, then home buyers are going to remain on the sidelines, because the affordability constraints of buying a house at over a 7% mortgage rate at a near record high price is just too much for the typical American household to bear, everyone. 84% of Americans say it's a bad time to buy a home right now. Mortgage applications to buy a house, they're at the lowest level in nearly 3 decades. And there's only 2 main ways to solve that. Prices need to go down and mortgage rates need to go down. However, in the short term, declining mortgage rates doesn't seem very, very likely, because the Federal Reserve is probably going to hold interest rates at their current levels for at least another 4 to 6 months, which makes home price declines the path of least resistance to restore balance into the housing market. But now here's an interesting question, everyone. What are the cities and the areas around America where the builders are having the biggest downward impact on prices? Because what you got to understand is that this is not an evenly distributed home builder price crash. Rather, the builders hone in on particular parts of America to build all their homes. Data from ReVenture showing that it's states like Utah, Idaho, Colorado, Texas, and Florida that have the highest housing unit growth rate over the last 5 years. In particular, we can see an area like Texas has seen an 11% growth rate in housing units. That's the 3rd highest expansion of housing supply in America, behind Utah and, interestingly, Washington, D.C. at number 1. So if you had to say where are the markets where the builders are cutting the price and where those price cuts are going to most adversely affect prices in general, it's going to be the ones on this list where the builders are most active. Conversely, here on ReVenture, we can see that there's a lot of states where the builders aren't active, like Michigan or Illinois or Missouri or even West Virginia, where the number of housing units has declined over the last 5 years. Well, the impact from these builder price cuts is not going to be as big in these areas in blue. blue. And ultimately, folks, this is all just part of the housing cycle, everyone. When there's a housing boom, the builders tend to go nuts in the areas where the prices go up the most, and then they overbuild just at the point in time where the interest rates go up to a level where people can't buy anymore, and just at a point in time when the economy starts tipping into recession, and then the migration train slows down, and then you get a crash. And ultimately, this is healthy. This is healthy for the housing market, particularly in these boomtown areas in the South and the Mountain West. And this is what needs to happen to bring affordability and future growth back into the market. Because I got to be honest, folks, places like Texas have gotten very, very expensive. With Business Insider reporting, people are now leaving Texas over rising costs. And so how do we stop people from leaving Texas or Utah or Colorado or Florida? Well, we could stop that from happening by having the home prices and the rents go down to a level where it becomes affordable again to live in these areas. That's what's going to stop the outbound slide that some of these boom towns are now experiencing. And I actually went to Texas a couple weeks ago because I wanted to see this for myself, everyone. I had to see all the home building. I had to see how much the prices were dropping. And when I went there, I was shocked. I saw images like this, which comes from Fort Worth. This is a D.R. Horton home building site in Fort Worth that I drove through a couple weeks ago. And I quite literally have never seen so many homes actively under construction. I don't know who the buyers of those homes are. I didn't see any for sale or sold signs. I don't know what D.R. Horton's doing out there in Fort Worth, but whatever they're doing, they're about to dump a lot of inventory onto the market. Additionally, I took a trip to Austin, Texas, into some of these neighborhoods where the builders went crazy, and I saw home prices and rents plummeting. The home builders have absolutely destroyed this neighborhood here in Austin, Texas. They've built so many homes. Now they're cutting the price, and this is getting to be really, really bad because in this community I'm in right now, we have sellers dramatically slashing the price. There's one seller in this community who's cut the price on their home by 22%. They can't sell it. We have another landlord in this community who's trying to rent their house out for $1,800 a month and they can't do it. That's less than the rent was over 2 years ago. This is absolute devastation in Austin, Texas right now. And this is something that's going to spread to a lot of other housing markets around America. And one has to start wondering, everyone, are we on the cusp of potentially a deflationary event in the US economy, and of course in the housing market more specifically? Because more and more when I go on Zillow, and you guys can let me know if you're seeing this in your market on Zillow, I'm just seeing bigger and bigger price cuts. I'm seeing the home prices go down. I'm seeing the rents go down. I'm seeing the builders report an 18% drop in sale price. I'm seeing used car prices now go down by 18% from peak. I'm seeing airline fares down by 30%. I'm seeing commodity prices now go down. And I'm wondering, is this the prelude to a deflationary crash in the economy? Because folks, the Federal Reserve, they've been super aggressive in hiking the interest rates over the last 2 years. The rates are now the highest they've been in 20 to 25 years. At the same time, and people forget this, at the same time, the Federal Reserve is sucking money out of the economy every day through their quantitative tightening program. The Federal Reserve balance sheet has now contracted by over $1 trillion from its peak in the spring of 2022 when the Fed balance sheet was at 8.9 trillion. This was after they printed all that money during the pandemic. Well, now the Fed balance sheet is down to 7.8 trillion, which is still above where it was before the pandemic, but is $1 trillion below what it was at its peak, meaning there's $1 trillion less dollars floating around the financial system than there was only 18 months ago. And we're starting to see the impacts of that when we see the money supply contracting, bank deposits are contracting. This is all classic historical signal for a deflationary crash, which could trigger a widespread decline in prices across the economy and a big surge in the unemployment rate, because the only other times in US history where the money supply has gone into negative territory, we've seen a depression. Actually, we've seen an unemployment rate above 10%. Now, I'm not saying for sure that's what's going to happen over the next year, everyone. I'm just saying it's something we need to think about because we're starting to see these early warning signs crop up more and more and more. And I think for a lot of people, maybe they would have a tough time wrapping their head around deflation, because all we've heard the last 2 to 3 years is about inflation, because the inflation's been really bad. The prices of goods and services have gone up nearly 20% since the start of the pandemic, with Bloomberg reporting that the cost of natural gas is up 29%, the cost of car insurance is up 33%, the cost of groceries is up 25%, the cost of pets are up 17%, the cost of water is up 16%. A typical grocery bill, if you just go to the grocery store, back in January 2020, you were probably going to spending $45 on your grocery bill. Now you're spending $61, which suggests that maybe deflation is what this economy needs, even if it's going to come with some short-term pain and an increase in the unemployment rate and certain businesses going out of business and people losing their jobs. Maybe deflation is what this economy needs to get back on a good growth trajectory for the long term, because right now there's just no room for the economy to grow with how expensive things are and with how much debt there is in the economy. And ultimately, deflation is simply the supply of goods and services exceeding the amount of money chasing the goods and services. And if we do experience that deflation, the builders are going to be an integral part of it. They're going to have to keep building homes and apartments, and they're going to have to keep putting inventory on the market and cutting prices, like on this listing outside of Dallas. This is in a wealthy suburb north of Dallas called Salina. It's a 3-bed, 3-bath house built in 2022. It hasn't been sold or lived in yet. See, initially the builder listed it for sale at $639,000 and has since cut the price to $540,000. That's a 15% reduction. So additionally, what this builder is doing is they're advertising a mega low mortgage rate. They're calling it a mega low mortgage rate. They're saying that you can get an interest rate as low as 5.1% for a limited time. The builder, I guess, on this one would do a mortgage rate buy down. Now, what's interesting is that type of mortgage rate buy down is going to cost the builder a lot of money. If they were to buy down your rate for the entire term from 7.3 to say 5.3%, that's probably going to cost the builder something like $25,000 to $30,000 on a home like that, which you can think of as almost like an additional price cut. So the real net price reduction on that home is over 20% when you factor in that mortgage rate buy down. So in some ways, the data from the US Census Bureau is showing the decline in median home price for builders from $497,000 down to $409,000. This 18% drop is probably understating some of the savings that buyers are getting relative to the rest of the market. However, what is obvious from looking at this graph is that the prices for new homes are still transacting at a level that's still about 20% above the pre-pandemic norm. So there's still more downside to go before true affordability is reestablished. And as I look at the housing market, everyone, and I look at where builders are cutting prices, I'm also seeing a lot of price cuts in the luxury market. Folks, I'm talking homes over $1 million, especially here in Nashville. I'm looking at houses where the builders in some cases have cut the price by $1 million. Like on this listing in Brentwood, Tennessee, everyone. This is a wealthy suburb south of Nashville. It's a 5-bed, 5-bath, 5,500 square foot McMansion on an acre lot built this year. You can see currently it's priced a shade below $2 million, but if we go back into the price history, we can see it was originally listed in May at close to $3 million. So the builder has cut the price by $1 million on this listing, and it's still sitting on the market several weeks later. Why is it sitting on the market? Well, if someone were to buy this house with a mortgage at today's mortgage rates, the monthly cost would be $12,000 a month, or almost $150,000 a year to buy this new house, which looks very nice, everyone, but still very, very expensive, even with the $1 million price cut. And what you need to watch out for if you live in a neighborhood where the builders were, buying lots and tearing down homes and then building a mega McMansion and charging $3 million for it, what you need to watch out for is that now that those luxury prices are going down, the builders are going to cut back on what they pay for land, which is actually going to drag the value down of all the homes in the area. That's right, everyone. If the builder is no longer able to sell their luxury house for $3 million, it can only sell it for $2 million. That means all the houses nearby are going to get cut down in terms of what their value is due to declining underlying land values. Now, of course, folks, we got to talk about kind of the other side to this argument with the builders, and that's the fact that despite the builders are cutting the price a lot and offering these generous mortgage rate buydowns, which cost a lot of money, the Builder stock prices are actually booming right now. When you look at the largest builders in America like D.R. Horton and Lennar, their stocks are trading literally at close to all-time highs. In the case of Lennar, their stock is more than double what it was before the pandemic, even in the face of these declines in prices. If we go to Lennar's earnings report in particular, you can see their most recent earnings report through the end of August, which is a little outdated, but through the end of August, they were saying that their selling prices were down 9%. There was a 9% decrease in the average sales price of home deliveries. So how is that possible, everyone? How are the builder stock prices booming even though the sales prices of their homes are way down? And the answer has to do with the fact that the cost of building a home has improved significantly over the last 1 to 2 years. The price of lumber has absolutely collapsed down to $540 per thousand board feet. You can see this is now back to the long-term norms of lumber prices, down about 60 to 70% from those crazy spikes we saw during the pandemic when there was that huge shortage of lumber. Well, no longer. The lumber prices are way down, which is yet another deflationary indicator and a signal that the builders can actually afford to cut the price more and give the mortgage rate buy downs because the cost of building is cheaper. However, folks, I wouldn't be surprised that even with these discounts, if the builders see a drop off in home sales in the coming 3 to 6 months, because when I look at some of the leading indicators of housing demand for home builders, we can see that forward-looking indicators of demand are actually very low. Watch this, everyone. The orange line tracks home buyer traffic at builder sites, data from the National Association of Home Builders, and you can see the buyer traffic at builder sites has collapsed down to close to the lowest level in a decade, while the sales of new homes have risen back up to their pre-pandemic levels, down 30% from the peak that occurred in 2021, back down to the levels that occurred around 2019. However, you could see a big decoupling in these two lines. Like buyer traffic and home sales used to track each other. No longer. The home sales are outperforming the buyer traffic, which suggests to me that there's downside risk on those new home sales, especially if inventory levels on the resale housing market begin to pick up in 2024. And I think that's a variable that a lot of people are missing right now and not considering, is that we could see all of a sudden a sharp increase in existing homeowners selling their homes over the next year. Because if, say the interest and mortgage rates start to go down a bit more, a lot of these homeowners who are locked out of listing, well, they're going to start coming to the market at the same time that investors are selling, which is a trend that I've reported on, we're seeing right now, at the same time that we're also likely to see an increase in mortgage defaults. So what these builders got to watch out for is that they might be facing more competition in 2024 from existing home sellers who are starting to get a bit more cognizant of the fact that they need to list and they need to cut the price. So yeah, folks, we are seeing this housing crash get real in the winter of 2023 and 2024. So make sure to pay attention in your market, especially if you live in a red state on this map. These are the areas where the builders have gone the craziest in terms of expanding housing unit growth. This is data you can find on Reventure app, the housing unit growth rate for your area. And in particular, you also want to check out what this looks like for your neighborhood. Because if we go in on Houston, we can actually see big differences within Houston in terms of housing unit growth. Like in some of these zip codes closer to the center of the city, the housing unit supply is actually down. There's fewer housing units than there were 5 years ago. Whereas if we go out west to some of these suburbs here out in Katy, housing unit growth rate's 37 to 80%. So the builders are going crazy out here, cutting the prices out here, and maybe a couple of them are cutting the prices in here. However, there's just way fewer of them building new units, so the impacts from the builder price cuts are not going to be as big in these areas in blue. And what I would encourage you guys to do, make sure to go on Reventure app, www.reventure.app, so you can track all of this data on housing unit growth rates, home values, inventory, and price cuts. You can track all of that data for your state, metro, county, and even your zip code, so you as a home buyer can make a more informed decision about when and where to buy a house. Reventure app has 2 plans. The first is free. You get access to 8 basic data points under the free plan, another 30 premium data points being available under the premium plan for $39 a month. These premium data points include overvaluation rate, property tax rate, how much home prices have crashed since the peak of the bubble in 2022, the price cut trends, the days on the market trends, the housing unit growth rate, the income and population growth rate, the cap rate. Those are all data points that you need to know as a home buyer or real estate investor in order to make the right decision about where and when to buy a house. So go to Reventure app right now, www.reventure.app, and sign up.